Thanks for joining us today. Forecasting cash balances can seem like a mystery or a roll of the dice, but there is a way to remove the mystery from predicting cash, and you do not need a crystal ball to make the prediction. I am sure all of you review your actual numbers each month, and you compare them to your budget, but do you have a cash budget? Creating a cash flow forecast with your annual budget and including it in your monthly financial review can be one of the best financial tools you give yourself. It will only take a few hours of your time up front, but it will return immeasurable value. In this video, we offer some helpful tips for forecasting cash flow and how is this different from your budget. First, you create your budget, as is seen here in a very simple example. You use your best predictions when budgeted revenues and expenses will occur across a 12-month period, and then you create the cash flow forecast that reflects the cash inflows and outflows and the impact that this has on your cash balance. The reason for having a cash flow forecast is to evaluate the timing of cash inflows and outflows. Remember, not every use of cash may even be on your profit and loss statement. Measuring and forecasting the timing of when cash comes in and goes out enables the organization to pay its bills on time. The forecast will predict or estimate the amount of cash you have on hand. It will help you decide if you need to rearrange bills, pull from cash reserves, or even consider borrowing money to bridge that cash gap. We are going to take a look at a sample cash flow forecast template. I'd like to point a few things out as we take a closer look. First, you can see that the categories all match up to the annual budget that we just looked at. This top line shows your opening cash balance, and this is automatically calculated for you. Do you see that your opening cash balance in February is the same as your closing cash balance in January? The top line, the revenues and expenses, are spread out in the fashion that you believe they're going to fall. This is the cash balance, not necessarily the budgeted one. You can see also there is an entire section here for income. These are income items when the cash is going to come into your account. Again, not necessarily when it's budgeted. You've got a section for expenses that show your total expense cash for the month. And then you have a line here that shows your total cash outflow for the month. Do you see that in January, for instance, there is a budgeted cash outflow that's negative, $8,150. But the line below it shows your rolling cash balance for the year. And even though you had a negative number for 1 month, you are in the positive at $132,006. Now, you may receive a statement of cash flows with your monthly financial package, but remember, monthly financials are a snapshot of a historical record. The cash flow forecast allows you to take your budget and put it into motion. It is a future view. You can take budgeted amounts and look at the next 3 to 6 months to see what your cash position will look like if a grant comes in late or a donor appeal doesn't bring in as much as you hoped. Also, you can see worst-case scenarios that may impact your decision to hold back on certain non-essential expenses. Cash flow forecast can give you clarity on strategic decisions that could take some financial resources. It can shape the timing of your development strategy or accelerate your collection of receivables if you have them. I'd like to point something out. The closing cash balance line. If you create your cash flow forecast along with your budget, and this is your first round, you may see that there are a few months where there is a negative number. You can see that in August, again in October, and in November, there is a rolling negative cash number. Don't be alarmed at this. You have time now to resolve the issue and come up with strategies on how to avert this. Again, you might defer some non-essential expense. Please remember that there is nothing more devastating to a nonprofit organization than running out of cash. And all of these things can happen within an organization that at year end has met or exceeded its budgeted goals. A balanced budget and meeting your budgeted goals does not guarantee an adequate cash balance. For example, let's take a look at this line right here, government support. You've been awarded a grant of $48,500 in June. That's when you expect the funds to come in, but you receive a message from the funder that the monies will be delayed. This is when the tool really comes in handy. You can go ahead and now enter the $48,500 in the month that you now believe the funds will arrive. Go to the month that you had budgeted and put that at 0. And let's take a look now at what happens to your cash balance. Do you see that now you have an additional month in July where your rolling cash balance is negative? You now go to your board and you know that you've got 4 months of cash flow that will be negative, and it's time to resolve the issue. The way to determine how much that you're going to need to inject is by looking at the highest amount of cash that's negative for the 4 months. In this case, it's $15,144. So you can come up here, and let's say you have access now to $20,000 either from cash reserve or from doing a bridge loan to get you through this gap, and you enter the $20,000 here. Do you see that that automatically changed all of these balances to positive? Well, remember, if this was a loan, you are going to have to pay it back. And you begin to take a look at which cash balance month puts you in a position to pay the loan back. You can see right here in September that there is plenty of money to pay the loan back, but if you take out $20,000 in cash, you're going to short yourself in October and again in November. And so you decide to wait until December and you put the minus $20,000 right there to show that you are going to pay the loan back. You still have sufficient cash here to meet your operating reserve requirements for the following year. So some helpful tips when creating your cash flow forecast. Number 1, use the same categories as your operating budget as we showed here. Number 2, once the known items are in place, then you can begin to plot out the revenue line with the associated expenses. You might have some expenses that happen prior to the revenue coming in, and you will need to account for that in your expense section. The focus of the cash flow forecast is timing. You already know the budgeted amounts, but now you are predicting the timing of the income or the expense. It is best practice to include a summary of your cash flow forecast in the financial package that you provide your board. This will help set the scene for what the cash needs are over the next fiscal quarter, and it can highlight a significant need that might call for action right now, such as dipping into reserves, borrowing, or it might even motivate your board to assist with fundraising. Again, the best practice is to create your cash flow forecasting spreadsheet as a companion tool to your budget. When you review your actual to budget comparison each month, you can adjust your cash flow forecast based on last month's actual numbers and then have a realistic, workable tool that will help you manage one of your organization's most powerful assets, the cash. Thanks for joining us today.